Hello and welcome to Trading Hour. I'm Reema Tendulkar. With me is Pavitra Parekh, and the sell-off is extending itself and it's quite steep right now. Currently down 140 points on the Nifty, lower by 3/4 of a percentage point. The Sensex has slid close to about 400 points. In the morning, we had a gap down opening, but then there was a recovery. The markets got back into the green territory, but since then, it's been a one-way fall for the markets. In the Asian markets as well, the rout extends itself. Even markets like Hang Seng, which were up close to about 0.7, 0.8% at some, in early trade, have now dipped into the red. So even Hang Seng has slipped 1.5% from the day's high. The Taiwanese markets are down 1.6%. The Japanese markets are down close to about 2%. So this is an across-the-board global sell-off that we are seeing. IT, of course, has been weak from the start go. So IT index is still down close to about 0.8%. But it's not that the incremental selling that we've seen in the last 1 hour has come in on the IT names. It's the PSU banking index, which mirrors the chart that you are seeing on the Nifty. The Nifty PSU banking index is down 2.5%. There you go. After the big outperformance over the last 6 months or so, the PSU banking index has come under pressure. Mid-caps too are underperforming by quite a margin. The mid-cap index is currently down 1.8%, so there is the sharp underperformance of the mid-cap space. Apart from that, weakness coming through on auto names, metal names, across the board, but it's particularly the PSU banking space where we are seeing the biggest knock.
Yeah, oh, absolutely. After all of these days of us talking about that big outperformance, you are definitely getting sharp, a sharp knock there. But this is a broad-based sell-off, all sectoral indices in the red. Like Reema was pointing out, the mid-cap index is what is really standing out today with a near 2% fall. In fact, for this entire week, it had been holding up. It was outperforming. But now, even the mid-cap index has turned negative for the week. So that is something to keep your eye out on. This is in spite of the fact that Reliance is sort of still holding on and is in the green, ONGC in the green, but there are just about 5 or 6 stocks which are managing to do that. On the downside, in addition to some of the PSU banks, you also have some of the auto names which are looking quite weak today. So take a look at M&M, you have Hero, Bajaj. I'm naming a few, and the entire real estate pack also continues to be under pressure. This is not the first time that we've seen this week, but do keep those sectors on your radar. That's what's going on with the markets. But let's now talk about some individual names which are in the news today. So from our research team, we have Abhishek, Sonal and Vivek standing by to bring you details on all of these names. So Abhishek, let's start with you. GMM Pfaudler, the stock has taken a sharp knock. It's down over 13% today. As sources tell us that promoter Pfaudler is all set to sell a sizable stake in the company. Take us through the details here.
Well, as you mentioned, Pavitra, now Pfaudler is looking to sell about 29.88% equity in the company, that is GMM Pfaudler. So in quantum-wise, it's about 1.34 crore shares, which forms about 29.88% of the equity. The offer size is about 2,283 crores in terms of INR and about 277 million in terms of USD. So Axis Capital is the sole broker over here. The floor price has been set at 1,700 per share, which is a sharp discount of over 11.5% to yesterday's closing price. So promoter holding will decline to 26.18% from the earlier 56.06%. Take a look at the history of shareholding that Pfaudler has had in this company. So in June 2020, it was about 50.44%. It declined to about 31.88% as of September 2022. And post this block deal, it will be less than 2% in the company. Back to you.
Okay, thank you very much for that. Let's also move on and talk about the oil and gas space. As Pavitra pointed out, ONGC is perhaps one of those few stocks holding up in the green. This is as the government has cut the windfall gains tax and the duty ahead of the scheduled fortnightly review. Sonal is here with more details. Sonal?
Thanks a lot for that. Well, yes, it's a big cut which is coming in as far as the windfall taxes on crude production and export duties on diesel and ATF is concerned. So for crude oil, windfall tax has been cut to 1,700 rupees per ton versus 4,900 rupees per ton. Windfall tax on diesel is cut to 5 rupees per litre versus 8 rupees per litre. On ATF, it has been cut to 1.5 rupees per litre versus 5 rupees per litre earlier. On petroleum, it continues to remain nil. Now, Jeffries last week had put out the fact that refining margins have come off substantially. Crude prices, we've been talking about that, they have also been hovering on the lower side, and that's why they expect export duties on both diesel and aviation fuel to be withdrawn in the near future. They also said that removal of the same would result in an EBITDA boost for Reliance Industries to the tune of $1 billion and will potentially, of course, remove the regulatory overhang as well. IIFL, in a conversation to us yesterday, had said that yes, if oil prices continue to see a downward movement, there will be substantial cuts in windfall taxes as well. And CLSA earlier, they have been talking about it, how government has been allowing these companies to realize oil realizations of around $75 to $80 per barrel, while these stocks right now are trading at $45 to $50 per barrel. So there is substantial upside which is expected as well. So the idea is crude prices continue to fall. Maybe the government will take a reasonable take here as well. Just to give you some perspective, when windfall taxes were levied for the first time on crude, it was 23,250 rupees per ton. On diesel, it was 13 rupees per litre. On petrol, it was 6 rupees per litre. And on ATF, it was 6 rupees per litre. So a substantial cut from there on. The expectation is if the downward trend continues, it could be withdrawn as well.
All right, Sonal, thanks a lot for getting us all of the details. By the way, while ONGC, Reliance, Oil India are all in the green from the day's high, they've still come off sharply. So do keep those stocks on your radar. And, from the highs, we've seen quite a significant correction in even these gaining names. But the next stock that we're tracking is Nava. This is Aswal Navbharat Ventures. This, as its subsidiary, MCL has reached an agreement with Zesco in a long-standing arrears dispute. In fact, the CFO Sultan Beg tells us that money due to MCL will come in tranches by August of 2023. So Vivek is here with the details of that. Vivek?
Well, the stock in focus is Nava, like you mentioned, it was earlier called as Navbharat Ventures. It's a significant positive overhang that has been lifted as far as this particular company is concerned. This has been a long-standing dispute that one of the subsidiaries of the company, subsidiary by the name of Mamba Collieries Limited, this is a Zambian-based subsidiary where the company has a 65% stake. So this particular arbitration or dispute was with, the DISCOM of Zambia, which was known as ZESCO, or Zambia Electricity Supply Corporation Limited. So now what has actually happened is that for a long time, on the back of overdue receivables, the company had gone to multiple arbitrational tribunals, and finally, both MCL as well as ZESCO have had a discussion, and they reached a consenting agreement as well. And now the arbitral tribunal based out of London has issued a consent award. This is in favor of MCL, that is the subsidiary of Navbharat Ventures. The outstanding and overdue arrears that are now due to MCL is around $518 million. Post-tax and post-debt repayments, the company told us that they expect around 227 million to come over here. Now this is a lifting of an overhang. The stock had derated on the back of this particular development, and also given the fact that overdue receivables will now come to the company, it's again been seen as a positive trigger. We had the management, as you mentioned earlier, on our channel. Let's listen to what they had to tell us.
This is a consent award issued by the International Arbitration Tribunal based in London, not in Singapore. By means of a consent award, it means that both the parties, MCL and ZESCO, got onto the table, agreed on bilateral terms, how the debt will be disposed of over the next course, and approached the tribunal to issue a consent award. So it cannot be challenged further because the parties bilaterally agreed and reached an agreement, and which the tribunal issued in the form of an award. As per the settlement agreement, it will come in tranches, and ZESCO has agreed that the entire money will be settled to us by end of August 2023. Out of the 518 millions, about 70 million will go towards the payment of VAT liabilities to the government of Zambia, which we believe that ZESCO will directly pay off to ZRA. And from the balance 447 million, we have an outstanding principal due to the lenders, which has not been paid since about 3 years. So over $220 million would go for repayment of the outstanding overdue principal amounts to the lenders. Balance amount is available with the company, and the board will take a suitable decision when the right time comes for the utilization of the funds, either in terms of the payout to sponsors or conserving cash for further expansion. We are in the verge of appointing one of the largest international property consultants to dispose of this land. As you know, this is a significantly very large land parcel on the eastern side of Hyderabad, over 60 acres. So it needs a decent amount of time to be invested by large property consultants in doing the due diligence and reaching out a proper deal.
All right, that is the management of Nav Bharat Ventures, are currently known as Nava. The stock is up over 8.5%, this after the 8% gain that it saw yesterday as well. But we have to get into a short break now. When we come back, we're going to shift focus from equities to commodities and tell you what's going on there. There are some sweet gains coming in there.
तुम तो मेरी रोशनी हो।
तेरी रोशनी हूं मैं, किसना?
Indiabulls Housing Finance Limited announces a public issue of secured redeemable NCDs, offering coupon rate of up to 9.80% per annum and additional incentive of 0.25% per annum. Tranche 4 issue is open for subscription. To subscribe, log on to indiabullshomeloans.com. For risk factors and more details, refer to the Tranche 4 prospectus available on the websites of SEBI, Stock Exchange, Company and the lead managers.
पुत्रवीर कमाल दिखा अपना, कभी टेबल बन जाता है तो कभी अलमारी।
वीर MDF आम प्लाईवुड से ज्यादा मजबूत, ज्यादा किफायती, दिखे चकाचक, दिखे टकाटक। Overburdened by your utility bills? Relax. Pay all your utility bills with Canara Bank AI1, the banking super app. Download today, क्योंकि आपके सपने हमारे अपने।
झाके रे झाके झरोके से झाके, देख के दंग है छोटे बड़े सारे। झाके रे झाके फ्यूचर को ये ताके, तरक्की को टुक टुक हर कोई ताके। झाके
Reimagineering brighter futures with smarter steels. ArcelorMittal, Nippon Steel India. Smarter steels, brighter futures.
Hey guys, welcome back. You're still tuned into Trading Hour. Now, while the market is still seeing sharp cuts, it's actually seen a little bit of a recovery in the past couple of minutes. So right now we're looking at a 100-point cut. So of course, still, broad-based sell-off. But in the past few minutes, you have seen a little bit of a move higher. Take a look at Tech Mahindra. It is the top gainer on the Nifty right now. And that one has seen quite a spike in the past few minutes. So that one is holding up well in the green, and it is the top gain on the Nifty right now. But let's talk about the commodity space. Manisha joins us, and today she's talking about one space that is seeing some really sweet gains. Manisha.
Oh, well, absolutely. Talk about festivals and, of course, the weather concerns. All of that has been pushing the sugar prices on the higher side. So much so that the international markets, the raw sugar prices have hit a high at around 5-year highs there. 21 cents almost on the charts is how we see that overnight. India's adverse weather can impact the standing crop is what the markets are getting bothered about. And also there were statements yesterday from an ISMA conference where the Indian Food Secretary has said that there is no sugar export quota extension being given until the month of January. So the new statement or the new quota will only come in by then. The second thing he talked about was to he told the companies to focus on specialty and refined sugar productions going forward. So that is what the street clearly seems to be reacting to. In the international markets as well, we're looking at a lower crop concerns from Brazil. Thailand exports have been on the weaker side as well. There are weather concerns there as well. And this time around, we also are looking at a small crop in Europe. And Europe also would be wanting to import sugar. And that is keeping the international sugar prices on a premium there. I also want to talk about cocoa because here as well, we've seen very strong gains come in. We are trading at a 4-week highs in case of cocoa at around $1980 per ton is how the prices are trading onto that one as well. It has to do with the international chocolate demand. Remember, it starts from Christmas, New Year to Valentine's. And the next couple of months, it is going to be strong cocoa and sugar demand. That's another thing that the street seems to be factoring in.
Okay, Manisha, thank you very much for that. Well, sugar is, I don't think you need a season, right, to consume chocolates and gift them. So that's the reason why even pre-Christmas, things appear to be on an
But take a look at some of these stocks, right? Like the sugar pack, it's so much higher. Rashri Sugar seeing a gain of 18% right now. You have Simbauli Sugar, which is 19% higher. So many of these, Sakti, Bajaj, Hindustan, all of these seeing outsized gains today. So maybe people are eating more Christmas cake.
Indeed. I am. Are you?
I am.
All right, let's slip into a very short break. When we return, we'll discuss market technicals. Mitesh Thakkar of earningswave.com joins us next. Welcome back. Let's continue to talk about individual stocks. That's where the big moves are. Deepak Fertilizer is higher in trades post announcing the demerger of its mining, chemicals and fertilizer business. Sonal is here with the details. Sonal?
Thanks a lot for that. Yes, it is an important update that has come in from Deepak Fertilizers. They have planned or announced demerger of their mining, chemicals and fertilizers business. Now, just to give you some perspective, because there are two transactions which are taking place here. There are two subsidiaries of the company, STL and DMSPL. STL is the one which houses both the fertilizers and the mining chemicals business. Now, from this particular subsidiary, the mining chemicals business, that is the TAN business, will be demerged into Deepak Mining Services Private Limited, which is DMSPL. The second transaction which is happening is amalgamation of Mahadan Farm Technologies Private Limited, which is a wholly owned subsidiary of STL, into STL. Now, of course, the first one is of a bigger importance, and that's what the stock is reacting to. In terms of their mining chemicals business, it is a sizable chunk, almost 2,400 crore rupees in terms of revenues. That's 44% of the total revenues, and that is the one which is getting demerged. The demerger ratio is at 1:1. Now, a couple of reasons why the company has gone ahead and announced this demerger. First is simplification of corporate structure. Two different businesses, so they are planning to demerge it. Economies of scale. They also talk about restructuring in line with their plans of moving away from commodity business to specialty business, and that's something that they have been very vocal about as well. Unlocking growth potential of each of the businesses, because they both are different businesses, one fertilizer and one chemicals, and that's the reason why they have gone ahead with this particular decision. It was not very expected, so to say, so it's come as a surprise, but definitely a positive surprise taken positively by the company. We'll have to see whether these two businesses will be listed separately or not. That is something we'll watch out for.
All right, Sonal, thanks a lot for getting us all of the details. The stock is up around 5%, but one which is not doing well today is Credit Access Grameen. This one is under pressure as Uday Kumar Hebbar, who's the Managing Director and Chief Executive Officer of the company, tells us that promoters may sell stake in the future of around 5% or more. So let's listen into those comments.
Promoters might sell about 5% per annum for at least in the mid-term total, not more than 10 to 12%. To give a liquidity to the old shareholders who have been invested and patiently with us, with promoter for more than 15 years. Our intention is to, promoter intention to reduce not more than 5% in any financial year, but not more than 10 to 12% overall in the medium term. But yeah, it will take step by step, not immediately.
Okay, that's the management of Credit Access Grameen saying that the promoters are looking to sell stake on an annual basis, or every year they may be selling up to 5%, but on the whole, the overall sale will not be more than 10 to 12%, which means perhaps in the next 2 to 3 years, the promoter holding could come down to 60%. The promoters separately also have aspirations to grow the insurance business. Let's talk about the market technicals. Mitesh Thakkar of earningswave.com is also with us on the show now. Mitesh, earlier when we chatted in the morning, you indicated that 18,300 is a very important level. We're almost there right now, just hovering above that. Is there a trade that you would recommend?
Yeah, I think we've hit those levels. We haven't broken them decisively. I think there was an intraday foray below 18,300, but the structure is very weak. So in fact, if today's low gets taken out, then I would want to short the index, but otherwise, use rallies to sell into, and close to about today's high of 18,425, 440, I think is the level to initiate short. So the outlook has changed from buy on declines to possibly, mildly sell on rallies. I think this looks like a correction which could get deeper with the coming few days. And we are also in the stock side exploring some shorting opportunities.
Okay, Mitesh, will you take us through your individual trades then that you have right now?
Yeah. I have a sell recommendation on HDFC Limited. That's a stock which is trading negative today, and recommend a stop of about 2660 here and a target of around 2600. The other one is Intellect Design Arena. That's a sell as well. Keep a stop at about 424, 425 levels and look for a 400 kind of a target.
Okay, those were a few trading ideas. Kotak Mahindra Bank has hiked the lending rates on an overnight to 1-year tenures by about 10 basis points. Across the board, we've seen the large banks go ahead and hike rates as well, deposits and even on the lending side. Get into a short break. We'll get you more on the markets on the other side.
Welcome back. You're still tuned into Trading Hour. The market has picked up a little bit more in the past couple of minutes, like we were telling you. So it's now just an 85-point cut that we are seeing. So there is a little bit of a recovery, like you can see playing out on your screen. So do watch out for that. Eicher Motors has moved up. Suddenly you have Reliance, which is holding absolutely steady. But Eicher Motors has seen quite a pickup. HDFC Life is now the top gainer. So that one also seeing quite a move higher. But let's get you an exclusive conversation now. Dr. Trehan of Medanta says that the Cleveland Clinic is his inspiration. Healthcare is a business with a soul, and medicine-first attitude will give good returns. Talking to Ekta at his flagship hospital, Medanta Medicity in Gurugram, he says that the focus is to make healthcare as reasonable as possible. So here's a slice of that conversation.
By principle, we do not want to be the most expensive in the market, no matter how high our facilities are. We want to make it as reasonable as possible, keeping in mind that as many people who can access this kind of treatment should benefit. It should not be for the elite. So if you look at our mix, we have all people, the highest people you can talk about in your hierarchy. I don't consider them high or low, but I'm saying that at all economic strata, all educational strata, government, all that stuff, we are agnostic. We want to give the same treatment to everybody because human life is the same, no matter where you come from. So we try to keep it as affordable, keeping in mind that you need a certain margin to be able to, one, renew yourself, which is very important because technology is the backbone, and technology gets obsolete within 7 years. This whole 20-25 crore machines, the company says it's end of life. I mean, these are bizarre things that have happened, but we are in the clutches of international manufacturers. Of course, with this Atmanirbhar, things are improving. We will, in times to come, produce our own MRIs and high-end scans and stuff like that, which we don't today. So we are totally dependent on these companies from around, and they can dictate. They said after 10 years, although the machine can be extended to longer, much longer, maybe 15 years, 20 years, some of the machines, but they refuse to give parts. They say, well, now we don't manufacture parts anymore. So you have no choice. So I'm saying that you have to keep it in mind that the pricing has to give enough that you can renew yourself, you can pay back your debts, and also leave enough margin for growth. So putting this together, I think that around 20 to 25% is the ideal margin which you should have in healthcare, because it's, like I always say, it's not a business, it's a business with a soul. It doesn't have, it's not cold-blooded in any way, it should never be. So for us, medicine first, because I have said it many times, that good medicine will give you good returns, but good business will not give you. So that's the whole.
So will the margins probably sustain at 20%? You've done 20% in the previous quarter. Is that the target?
No, I mean, if it goes up 2, 3, 4%, this is not bad. This is good. It only gives us enough elbow room to create more. But you don't want to cut corners. You never want to compromise the quality of treatment. You do not, and like I said, you don't want to deny people. Because, people who are already on the sidelines, okay, they deserve medicine as much as anybody does. So you try to make it possible in whatever way, how. Now you see, the government has also taken that view with Ayushman coming in. There is the relief, there's a safety net for 50 crore people. And now the government is also talking about increasing that net, and how it should be. People who can afford should buy private insurance. People who can't afford should be given this kind of safety net which the government has done.
Correct. The payer mix, that brings me to the payer mix since you mentioned government. How much do you probably get in terms of, say, institutions or government-related institutions in terms of payments? And what are the receivables as well? Because many hospitals are actually looking to reduce the percentage that they get from the government or institutions.
I don't think that's the right approach. The approach is that you offer your services at a level that people who can afford and have private insurance, that number increases. But you don't have to deliberately reduce the number of people you're going to service because they are in the government. No, they also, see, how do you recognize the contribution of anybody or everybody to the country, to the environment, okay? Believe it, India, with the diversity that we have, held together for 75 years is a major accomplishment. You know what's happening to all our neighbors. They're all falling apart. So, who all have contributed to that? Basically, the bedrock of ours has been the bureaucracy.
All right, that was a very special piece from our series that we have planned for you, Medicine Box, a deep dive into the world of pharma and healthcare. So catch snippets of this conversation all day today, only on CNBC-TV18. All right, let's actually move on and talk about a very interesting note that came through. This is from CLSA, and they're talking about electric vehicles. Rima, they're sounding extremely bullish on this space.
Well, you know, I don't know how many, at least I have debated whether it's time to switch from an internal combustion engine or to an EV, right? And I'm sure a lot of our viewers must have thought that as well. But you hold back because upfront you have to pay a lot more to acquire an EV car versus your regular car, right? Say a Tata Nexon EV versus a Tata Nexon petrol as well as diesel. So CLSA has done some analysis and they're saying that the break even, okay, which means the cost of ownership, the increased cost of ownership minus the amount that you save on your fuel on an annual basis, the break even is about 2 to 4 years on an average. And here's the analysis that they've done. So first they've taken the Nexon petrol versus the Nexon EV Prime, right? And here they're saying the break even is close to about 3.4 years. If you take the higher end, then the break even is about 5.5 years. If you move on now to the diesel version, right? This is the petrol version. If you move on to the diesel version, you know, this is actually not giving the easier picture. If you could just pull up the break even chart of what it takes, there you have it. For the lower end variants, it's about 2 to 3.5 years. If you go for the premium end variants between petrol and diesel, it's close to about 5 years on an average. So that's the key takeaway, right? The break even, if you want to switch and you buy a lower end EV version, whether it's petrol or diesel, then the break even is as low as 2 to 3.5 years. So which is why they're saying the rise of electric vehicles is going to be inevitable in SUVs. And here they've done the analysis of Tata Motors Nexon as well as Mahindra's XUV 700. And they're saying that because the break-even cost has been, the break-even period has been coming down now, the switch to electric vehicles is going to happen at a very rapid pace. So they're saying 25 to 30% of the SUV segment will shift to electric by FY27 to FY30 on an average. They believe Tata Motors and M&M are likely to lead the race in electrification of this whole SUV segment as they are the first mover advantage. They're launching 8 to 10 new models each in the electric segment over the next 5 years, and they are spending close to about 100 billion rupees to 150 billion rupees over the next 5 years for the electric vehicle cause. And they believe that between the two, they will command about 65% of the market share by FY27.
All right, very interesting report there from CLSA on EV. So they're sounding quite bullish on this entire space. By the way, important flashes from Dr. Reddy's on the bottom of your screen. One of their arms has stopped sort of clinical trials for one of their drugs, which was an oral drug meant for psoriasis. So they've stopped that, saying that it's not going to really help moderate to severe psoriasis. But with that, we're going to get into a short break now. When we come back, we'll discuss market fundamentals. Vikas Khemani of Carnelian Capital Advisors will be with us.
Welcome back. Let's talk about the markets and the way forward. Vikas Khemani, founder of Carnelian Capital Advisors, is now with us on the show. Vikas, morning, and thanks for joining in. There is a lot of trepidation going into 2023. Many believe the bulk of the big gains are behind us. From here on, next year could be a year of moderate gains, and it all boils down to the kind of stocks that you select. Can you tell us the top-down macro setup as you see it for the Indian markets, and what's the best approach?
Yeah, hi, Rima. I think, I echo a similar kind of sentiment that, we have reasonably rallied in last few months. We've been, sort of quite positive about markets, since July, August. And, good run has happened. And as we get into 23, while the India story continues, the growth in the banking sector continues, growth in automobile sector continues, overall broader earning outlook looks very, very reasonably smooth. There might be some headwinds coming from global setting of a little bit of slowdown in the demand because of the ongoing interest rate rise. But that's going to have a limited impact. But if I were to look at 23 as a year, there will be events in terms of state elections, setting on the stage for 24 elections. So it will be a sort of mixed year. It should be definitely a positive year. But I guess one has to keep in mind the overall environment. Good part is that the interest rates are kind of, in my opinion, likely to peak out very soon. Inflation has peaked out. So I think those things will be tailwind. The headwind would be a bit of a demand slowdown in the developed markets. But as far as India is concerned, I think we are reasonably well placed. Our domestic demand looks reasonably good. Our investment cycle has picked up well. Manufacturing is kind of doing well. So one has to kind of navigate this, tailwind and headwind kind of environment. Net, I remain quite sort of positive on the markets. And at the end of it, it boils down to sector selection, stock selection, and it is always the same. And to make money, you will have to keep looking. Some sector will do well where the risk reward is good, and that's how one has to always navigate the markets.
All right. Hi, Vikas. Good morning, and thanks for joining us. So, like you said, it's going to be about sector selection, stock selection. So, take us through what you are really selecting at this point. And like you said, global demand, could see some pressure even continuing into next year. Would you avoid all of these global-facing companies?
So, I think, again, it's very, very, sector specific one has to look at. But broadly, right now, we are very bullish on banking and financial services. We think that the cycle has just begun, and you will see, 23 also would be a good year in terms of credit growth, in terms of profitability growth, some of the write backs from the NPAs coming. So that would continue to be the, I would say, leader and the star performer. Automobiles can continue to do well because we are coming out of a long cycle of no demand or low demand and supply disruption. So now the volume growth and the earning growth should be decent. I think manufacturing oriented players where we are seeing big shift from China coming towards India, even if they are globally placed, but the shift is helping in terms of creating the demand environment, are again well placed. Capital goods, which is focused on the investment cycle, is well placed, especially from an Indian perspective. So I think these are the 3-4 broad blocks of the market which will outperform market significantly. IT, per se can remain sort of moderate growth to, while a demand environment so far looks pretty decent, but what happens is the stock market sort of looks at the perception of the impact on the demand because of the global slowdown. So I think companies will do well. Stock market performance, I have no idea how it will pan out. I think most companies should deliver between 12 to 15% earning growth, which is a very good growth for a sector of that kind. So broadly, I think net I see reasonably positive market, reasonably a good market. But there will be events like state elections, news around the 24 elections. So all those things will also kind of color the market, and one has to be cognizant of that fact.
Particularly on IT, you said that we should expect about a 12 to 15% type of an earnings growth next year. But what about the PED rating? Do you think the worst of the PED rating is behind the Indian IT names? The downturn that we've experienced through 2022, do you think we are in the final stages right now, and therefore it may make sense to do a technology SIP type of investment from now on for the next 6 months?
So in 21, I think this companies grew as very well, and that got re-rated, and maybe probably got stretched on the upper side. And we saw concerns around the demand building and stock sector got de-rated, while the earning growths have not kind of really disappointed in a big way. Might this small deceleration happen, but not a big deceleration. Order book intake remains reasonably strong. I think attrition issues were kind of clouding a lot of worries, which are settling down. Currency tailwind is helping. So some of those they are positive and they are sort of a bit negatives. So I would say that technology as a sector will do well. It's a non-discretionary demand. Companies will have to spend. Now the growth, whether it will be 12%, 15%, only time will say. If it ends up being on the 15%, it will deliver well. If it is 12%, probably you will see that kind of returns coming through. But I would say that given the fact that it has a 3-4% dividend yield profile and promising sector, one should definitely invest.
Okay, one should definitely invest. Vikas, you're sounding very positive. The other space I want to talk to you about is on the entire consumption theme, right? Because there's such a divergent trend playing out there. On one hand, we are talking about commodity costs coming down, which is a good thing. But of course, the demand the demand recovery has not quite been linear. So while urban is doing well, rural is still quite not back at pre-COVID levels. Do you think this is something that can keep the space under pressure for a while?
So I think it is possible. I mean, demand right now is a bit slow, especially on the discretionary side. And so probably consumer staples might do well, but the discretionary side will be little slow as we see in this quarter, and probably might remain so 1 or 2 quarters. And on the top of it, most of the companies are reasonably premium value. So I guess to that extent, stocks might not do well or might kind of consolidate in a narrow range. So we think that there will be the right time to kind of look at it, because as India goes through significant scale up in the per capita income, discretionary spend always goes up, and it will go up. But in a shorter term and a medium term, it might sort of remain a bit sideways. But there will be period of time when one should look at, and there are companies still in that space also looks interesting. So it's again you really can't broad brush. You have to kind of look at the company business model, the risk reward, valuation, all those things. So, but net long term perspectives remain positive. Medium term, I guess there should be some consolidation.
Given the risk reward, do you think it may make sense to allocate more money into debt next year?
I think as the interest rate peaks out, of course, some amount of money will, as we get closer to 7.5-8% kind of rate. You will see money will flow there, especially in the bond market. And I guess somewhere around middle of next year, late next year, at least, if not anywhere else in India, I believe that the environment will become for interest rate cut again. And as that happens, you can see a bit of a gain coming on the fixed income. So it really depends on the individual profile. But definitely, I think debt allocation is likely to go up, and into the next year. So especially from a sort of preparing for interest rates cut in 23-24, late 23 or 24.
All right, Vikas, we leave it at that today. Thank you very much for joining us with your outlook on the markets as well as some of these individual sectors that you like. That is Vikas Khemani telling us that we might see some pressure in the global markets continue into the next year as well. But for India, the impact might be limited. He's sounding quite positive on a lot of these sectors as well. But with that, we're going to get into a short break now. When we come back, we're going to get you some more market action and opinions. So stay tuned for that. Welcome back. You're still tuned into Trading Hour. For the markets, we're seeing around a 95-point cut that we have seen on the Nifty right now, so 0.5% lower there. But it is really the mid-cap index, like we have been pointing out, which is seeing the maximum pressure today. So that one is still down 1.3%. And it has recovered significantly, like you can see on your screen. We were down almost 2% at one point. So we have come off those levels, but still significant underperformance to what's happening on the index level. The Nifty Bank also exerting pressure. It's down 0.6%, dragged lower largely by the PSU banks, like we have been pointing out. So that is where the market is at. But as we wind down on the show, let me leave you with some market opinion. As part of our Outlook 2023 series, Prashant caught up with S. Narain, Chief Investment Officer at ICICI Pru AMC, to understand how he expects the market to behave in the next year and why he believes asset allocation is the way to go.
If you look at the last month, what we saw was that debt index fund have received huge inflows, and that's something which possibly as a product didn't exist 2 years back. So I think clearly we are seeing a situation that people will consider debt and SIP both, and that will be the change which we will see in 2023. I think the big call will be that inflation will become much smaller as an issue in 2023. And therefore, we are in a situation where multi-assets become very interesting, that you consider all the asset classes. You consider a product like multi-asset, which can invest in debt, equity, gold, silver, REIT, InvIT. You can do everything. Because I think that kind of an asset will become much, much more interesting because you're still going to have a volatile year ahead. So large caps became the area where bulk of the selling has happened this year. So large caps became the area where valuation comfort is there to a higher extent. Mid cap and small cap, the mutual fund industry ensured that there was continuous SIPs. So that area has seen virtually no selling. So those areas, the valuations are not cheap. See, you need some wave of selling for the valuations to correct. And there has been no wave of selling for years now. So, and retail was also positive. So that's not an area where we have seen any selling. Once you see selling, the sector's valuations correct. So that's why we prefer large caps over mid caps and small caps. No, I actually told them you have to take tactically smaller positions, and it helped us a lot. If you look at it in the last 1 year, the fact that, people, the old fogies like me ensured that we took smaller positions helped us a lot because many of them corrected 50, 60%. And now we told them, look at everything with an open mind. And if you look at it, some of those new age companies, we would have our highest ever position today after a 50% fall, not 1 year back.